Hello, brothers and sisters of Accounting 201. This is Brother Lewis coming to you regarding questions 4 and 5 on the quiz access. One of the students had asked that I walk through this problem to provide some more context about how it all comes together. So this is probably a nice full exercise that hopefully will point out some things that you need to be aware of as you apply the reading to actual projects. So I'm going to walk through each of these 4 different scenarios and walk through the journal entries associated with them and hopefully identify some of the logic that is necessary to help complete it. So it's given you a series of information on Allied Merchandisers, which was organized on May 1st, and the company Macy Company, which is a major customer or buyer of the Allied seller products. So let me make this a little bigger just to make sure that everybody can see it. There we go. Maybe that's a little bit better. Let me squeeze this over just a tad. There, that might help a little bit better in terms of reading. Okay. So let me just pull up Excel too while I walk through this, because effectively what we're going to do is we can convert this data into journal entries. Well, really an analysis and then journal entries, right? So I want to capture what I can as I go along and see what we got. And what I want to do, of course, is put in a date. Let's see, an account, a debit, and a credit. And I'll just actually put a reference. And well, these are all dates, so that should be fine. Okay, now, as we look at this also, we notice that it's asking us to record purchases, purchase returns, and purchase allowances. So we're focused on the purchasing side of a particular company, more than likely, right? So it says prepare the appropriate journal entries for Macy Company. And Macy Company is the, let's see if I can do this a little better, is the buyer of any products from Allied, right? So really want to focus in on Macy as the buyer and any journal entries impacting Macy Company, right? Not necessarily Allied, because Allied's on the other side of the coin. We really don't care about that side of the coin. We don't want to worry about heads. We want to worry about tails, okay? And so we want to make sure we just focus on Macy Company, any journal entries that they have to make as part of all these journal entries. And might be in some cases where people get tripped up, is to focus on Macy, not on Allied, just Macy. Okay, so record each of the made transactions. Macy is a retailer that uses the gross method and perpetual inventory system. Okay, that may or may not be helpful right now, but we'll see as we go through each of these transactions. It purchases these units for resale. Okay, so they buy it at one cost and they mark it up and sell it at another. If no entry is required, select no entry. So that's an immediate clue that there's going to be something in here that's likely to be a no entry. Okay, so why don't we go ahead and get started, and then we'll see how I do on the actual results and see if maybe there's a place that my logic was incorrect. Okay, I think we might need to make that a little bit bigger. That's fine. Hopefully we'll have just enough room for all this at some level. Let's take this one up a little bit. There we go. Okay, now May 3rd. So that one's an easy one, 5-3. Question is, Allied made its first and only purchase of inventory for the period of on May 3rd for 3,000 units at a price of $9 cash per unit. Well, is this Macy? No, it is not Macy. Is there anything about Macy in here in this thing that even relates to Macy buying something from Allied? The answer is no. So reality is this first one is a no journal entry. No journal entry required. Okay, that was pretty simple. Actually, let's so this can view it. We want to do a freeze panes just right where it's at. That's fine. Okay, no journal entry required. Okay, so now we go to the next one. What is this? 5, 5. Okay. Allied sold 1,500 of the units in inventory, 1,500 of these 3,000. Okay, that's cool. For $13 per unit, invoice total of $19,500 to Macy Company. So Macy bought 1,500 units at $1,300 a piece from Allied under the credit terms. Now, this is probably something you're gonna have to remember, right? Because there's probably gonna be something later that goes over this. 210 net 60. So that means 2% discount if paid within 10 days of the invoiced amount, right? Or the purchase date. Otherwise, the net amount is due in 60 days. Okay. The goods cost Allied $13.50. We don't care about this because we don't care about the seller side. We only care about the buyer side. So in this case, we're going to purchase inventory, right? Macy is going to purchase inventory. So since it's a purchase inventory, we're just going to go ahead and merchandise inventory. Sometimes it's just inventory. I'm not sure, you know, but we'll make sure that we'll just follow this. Merchandise inventory. Let's make this a little bigger. There we go. Merchandise inventory. So Macy is buying it for $19,500. Okay. That means it's coming out of cash because oh no, this is not cash because it's accounts receivable, right? Under credit terms. Credit terms is a big issue here. So accounts receivable, I think. This is Macy, right? Oh no, accounts payable. Sorry. I'm thinking on the wrong side too. See, that's what happens when all is wrong. So they bought it on a credit, so it's a liability that they have to pay Allied at some point for $19,500. There we go. Nothing else there we need to do. It's just a purchase. Okay. Then on 5/7, Macy, which is the buyer, returns 150 units because it didn't fit the needs. And they already know, they give you the number here, 19,500. And we really don't care about Allied. All right, so that means that there's effectively a credit accounts payable, right, for the 19,550. Now, if we want to check that, let's just double check. Plus the 150 times the $13 that they bought it at, right? 19,500. Perfect. Okay. And this would be from merchandise inventory because it comes back out of the inventory. Credit is a reduction, so it's taking it out of inventory and taking it out of the payable. Now, on May 8th, 5/8, Macy discovers that 150 units are scuffed, but are still of use, and therefore they keep the units. Okay, but Allied gives a price reduction or allowance and credits Macy's accounts receivable for $750, which effectively means they're payable. Macy gets a $750 payable to compensate for the damage. So this is still on the Macy side. So we should still see the same type of entry here, right? So we can just copy this down here. And what would that be? So it's 750. So reduction in accounts payable by 750 and a reduction in merchandise inventory for 750. Okay. That's that one. And then we have one last one. Allied received payment from Macy for the amount owed on May 5th. Okay. So they received it on the 5th, which is 10 days, right? So they paid it within the 210. So there must be a discount that Macy's going to take. All right. So we got to figure out the discount. We have to figure out the amount paid. We have to figure out the cash. Okay, so let's go here first. So 515. So first of all, we know that there's a reduction in accounts payable. But okay, so we know accounts payable is one of the numbers, one of the accounts. We also know that there's going to be, because they're taking a discount, the discount is going to come out of inventory, so there's going to be a merchandise inventory value. And we also know that they paid with cash, so we got the cash. Now the cash might be the easy one to figure out, because the cash is going to be what they owe minus 2%. So what they owe is the original amount, the 19.5, minus this accounts payable, minus this, and you're going to take 2% off of it. So we're going to put a little brackets here. And actually, there's another way of doing this too. But we're going to do it this, well, how should we do this? Okay, I'm going to do it this way, and then I'm going to show you a different way, just so that you can see two different approaches to figuring this out. So we know that the total accounts payable is that the amount due is the 19.5 minus the 19.50 minus the 7.50, and since they're paying it within 10 days, they're going to take 2% off, which really means times 1 minus 0.02, or 2%, 98% of the total, right? They're going to pay 98% of the total. So this theoretically is what they should pay based on what they have. Is that right? 19.5 plus that minus that. Okay, should be that. So then what's coming out of accounts payable? Well, what's coming out of accounts payable is the same thing. That minus this minus this. Oops. Okay. Because that's what's in accounts payable right now. And the difference between these two is going to be the discount. And the discount is going to be a credit side, because debit is larger than the credit, and sort of in order to make sure it balances, we need to put the credit in here. So we're going to take that debit amount minus this credit amount, and we get 336. Okay. So that effectively gets us the buy side of this transaction. Right, all the buyer stuff. Okay, so let's check to see if we got it right. Okay, first question, nothing required. Perfect. Second one, something required. Okay, that's right. Next one, 19.5 is right. 750 is right. 16 is that 16,800, 336, and 1646. Okay, we got the buy side right. Now my guess is part 5, or problem 5, is going to be the sell side. Okay, so let's look at that. Oh, that's the explanation. Already got that down. See how they did this about the same to get to the 1646, I think. Is that right? Yeah. 1646, they took 19.5 minus the 1950 minus the 750 times 2% to get this amount right here, right? That's how they got that. They already knew this because it was just, you know, the math already. This times 2% gets you this, and then you just figure out what cash should be. You know, the 16.8 minus the 336 equals the 16,464. That's how they approached it. So I approached it a little bit differently. I figured out what the total cash was. I knew what the accounts payable would be based on the math, and then I just did the difference between the two. Either way it works, right? It's all math. So however you get to it, there's probably 2 or 3 different ways of getting to it for sure. All right, so that's 4. Now my guess is 5. If we go to 5, where's 5? 4 and 5, so 5 must be down here. Okay, so now we're going to do prepare the journal entries to record the following transactions for Allied, assuming it uses a perpetual inventory and gross method. Okay, you can pretty much ignore this right now, but Allied, right? All right, so Allied, we're gonna do the same thing, but on the Allied side, right? So I'm gonna keep this. I'm actually gonna put this insert. No, Control Z. I will do insert, and this is the entire row. This is the what was her name? This was Macy, I think, right? Macy. Where's Macy? I think it was Macy. Yeah, Macy Company. Okay, so this is Macy Company journal entries. Okay, and down here we're gonna do, is it Allied? Be helpful if I had a long-term memory and it wasn't so short. Allied. Allied, what are you? Okay, so Allied. We'll go back up to the top again because now we're going to focus on Allied. There we go. Allied journal entries. Same thing, 5.3. Now on 5.3, Allied made its first purchase at a price of $9 cash, right? $9 cash. So I'm going to assume that it's not on credit. So based on that, they're going to buy merchandise. So same thing, merchandise inventory. So they did, so $27,000. Okay, that's going to come out of cash. $27,000. Okay, that one should be pretty straightforward and easy. So they say, you know, easy. So now the next one is on 5.5, right? So Allied sold 1,500 of the units in inventory for 13 per unit to Macy's. Okay. Cost of goods. Are we going to worry about that? We probably are. So we're going to do, we have to do two transactions on this one. We're going to do a sales transaction and then a cost transaction, or a revenue transaction and a cost transaction, right? So let's call this, first of all, they're selling it on credit. So we're going to accounts receivable, right? And we're going to have sales, basically. And so that's going to be for Allied sold, total Allied sold 19,500. Okay, so 19,500 is their receivable and 19,500 is their sale. Now you also have to have a cost component to this, so 5.5, because you have to match your revenue with cost. So you're going to make sure you do the transactions at the same time. This one, you're going to go to cost of goods sold, and you're going to pull it out of inventory, merchandise inventory. Okay, now they're telling you right off the bat what that amount is. Where was it? Under cost. Yeah, okay, so the goods cost Allied 13,500. 13,500, and you can actually do the math on this as well just to verify it. So they sold 1,500 units, 1,500 times what's their cost. They paid $9 a piece. It should match. Voila, it does. So good deal. You could, you know, if they didn't give you the number, you'd have to go back to these and figure out what their cost was in order to figure this component out, right? Just like this one, the sales would be the 1,500 times $13 per unit, right? Should be the 19,500. So no matter what, you should be able to back it in by quantity times price, quantity times cost per unit, okay? Now the next one, Macy returns 150 units back to Allied. So Allied has to take that back, right? So they have to reverse their sale and their cost of merchandise. Returns 150 units because they did not meet. Yeah. So we're going to do just the opposite of this one. So on 5-7, we're going to do first the reversal of this one. So we're going to do sales first. And we're going to do accounts receivable second. Receivable. Okay. And we know what this is. So it's 150 units, invoiced amount 1950. Oops, 1950 and 1950 here. Okay. Now that's just the revenue side. Now we have to do the cost side. Same transaction, 5-step transaction date. The cost of goods sold and merchandise can be flipped because instead of a sale, we're doing a return. So you're going to do merchandise inventory here, and you're going to do cost of goods sold here, and that is 1350, right? So 1350 here and 1350 here. Voila, right here. 1350 is the cost, price is 19.5. So we got that one. So then on 5-8, Macy discovers 150 users scuffed. Okay, so they're not returning it, they're just going to get a credit, right? So in this case, we're just doing a sales return and allowance, right? Sales return and allowance. Sorry, did I do this right? I just remember sales, returns, and allowance. Okay. We wanted to do the 5-7 one with to sales returns and allowance, so you keep it separate from your original return sales. Okay, with that though, we still have same one on this one though. It's a sales return and allowance, so we can just use this. Actually, we can use this whole thing right here, copy, because they're not returning the full thing, they're just doing a sales return. So on this one then, we're going to do scuffed, gives a price reduction, which is an allowance, credits receivable for 750. Okay, so you're reducing the receivable and you're debiting it to sales returns and allowances. And lastly, the payment. So on 5-15, you already did the calculation, so there's no reason to redo the calculation. You just have the flip side going on for Allied as with Macy, right? So let's just go get that real quick, right? And it's going to be slightly different accounts, but we're going to put this over here. Oh, that didn't work, did it? Let's show you the actual thing then. Okay, I won't do the quick version, I'll do the long version. So we know that they're going to get cash. We know that there's going to be a sales discount. And we also know that there's going to be a accounts receivable account, receivable account. That's impacted those three: cash, sales discounts, and accounts receivable. Okay, so the long version is same thing, just the opposite. We know what the receivable was originally. There's the receivable minus any debits to receivables, which is right here, minus this receivable should give me what the accounts receivable is, which magically matches the 16.8 in payables. Okay. And we also know that 336 is going to be the discount. So since we see this, let's just go ahead and put the discount over here, because it's on the opposite side, right? It's on the opposite side of the coin, 336. And therefore, we know what the cash is. We already know what it is above. We already calculated, but it's this minus the debit. Okay, that's 16,464. Should be exactly this 16,464. So you notice how both sides of the coin are equal, buyers and seller transactions. Really, the only difference on the seller side is that they have, when they book a sale, they have to book the purchase price as well as the cost of that item to their income statement, basically, so you can get a profit loss off of that. Okay. And with that, I think that's all we have to do, right? Yep. Okay, so let's see how we did. Okay, 4, go down to 5. Okay, merchandise inventory, 27. Cash, 27. Accounts receivable, 19.5. Sales, 19.5. Cost of goods sold, 13.5. Merchandise inventory, 13.5. Sales return allowance, 19.5. Accounts receivable, 19.5. Okay, not too bad so far. Merchandise inventory, 13.5. Cost of goods sold, 13.5. Sales returns and allowance, 750. Accounts receivable, 750. And lastly, cash sales discount accounts receivable, 16.4, 64, 336, and 16.8. There you go. That is how you walk through the buy side and the sell side of these transactions and record them in the books. If you have any questions, give me a holler.